You're about to discover why most traders lose money before they even open a position, not on the trade itself, but on the entry. This is the cost nobody talks about, not the slippage, not the commissions, not even the bad luck. It's the systematic bleeding that happens the moment an amateur decides to pull the trigger without a framework. Here's the brutal truth that will sting if you're honest with yourself. 87% of retail traders fail because they enter trades like they're buying coffee at a drive-thru. Emotional, rushed, unconfirmed. They see a stock moving, a crypto pumping, a currency pair breaking a level, and they think one dangerous thought, I'm late, I better jump in now. That's not trading. That's not even intelligent risk-taking. That's gambling with conviction. And the conviction is the worst part because it makes the gambler feel smart. The professional trader does something entirely different. They wait, they construct, they confirm. And by the time they enter, the hardest part, the part that costs amateurs 40% of their capital, is already done. They've filtered out the noise. They've eliminated the trap entries. They've moved from reaction to action. I've watched traders turn $10,000 accounts into $50,000 in a single year, not by finding more winners, not by having a higher win rate, not by getting lucky, but by entering fewer, better trades. The difference between a trader who makes $40,000 on a $10,000 account and one who loses the whole thing isn't intelligence. It's process. It's a formula, a repeatable, emotionless protocol that filters noise from signal before capital is at risk. This isn't theoretical philosophy or motivational talk. This is mechanical. This is provable. Jesse Livermore made his entire fortune on one principle, one that he learned the hard way through catastrophic losses and redemptive comebacks. Entry determines 60% of your profit or loss, not exit management, not position sizing at the point of entry, not take profit levels. Entry, the decision to pull the trigger when the market is screaming at you to act, and the discipline to wait when it's screaming at you to get in. Most modern traders reverse this logic entirely. They obsess over when to sell. They watch YouTube videos about perfect exit strategies. They set stop losses and take profits before they even understand why they're in the trade. They have an exit plan but no entry plan. That's backwards. An amateur enters first and thinks later. They're reactive, following the chart like a dog chasing a car. A professional thinks first and enters later, and that delay, that pause, that moment of discipline is where the money lives. It's where the edge is carved out top bar. The next few minutes, I'm going to walk you through the exact step-by-step formula that separates the profitable professionals from the account-draining amateurs. I'm not here to sell you hope. I'm not going to tell you that trading is easy or that you'll be rich in 3 months. I'm here to show you a mechanical, repeatable system that will eliminate 70% of your bad entries immediately. 70%. That's not hype. That's the difference between having a real edge in gambling with better odds. Here's what makes this different from everything else you've heard before, and this is critical. This isn't about finding the perfect entry. The perfect entry doesn't exist. Markets are probabilistic, not deterministic. What this is about is building a filter, a confirmation system so tight, so disciplined, so mechanical, that you enter only when the odds are astronomically in your favor. Not 51% in your favor, not 60% in your favor. I'm talking about setups where the structure, the volume, the timing, and the context are so aligned that the probability of success climbs above 70%. And once you're entering setups with 70% win probability instead of 50%, your account doesn't just grow, it compounds. The amateur trader thinks entry is about being first, getting in before everyone else. FOMO, fear of missing out, is the emotional driver. They see a move and feel like they're falling behind, like the opportunity is slipping away. So they enter, and by the time they're in the position, they realize everyone else was already in. They were the last to know. They're at the back of the line, about to be slaughtered by the professionals who entered 3 days ago and are now taking profits. The professional trader thinks entry is about confirmation, not speed, confirmation. They ask, has this setup been tested before? Do I have volume behind this move? Has enough time passed for this pattern to prove itself? They're willing to miss the first 10% of a move if it means avoiding the 30% washout that catches amateurs off guard. Let me paint you a picture. 2 traders, both watching the same stock. Stock XYZ has been beaten down. It's been rejected at $45 repeatedly. bounced off that level 4 times in the last month. Then, one Tuesday morning, it gaps above $46. It's moving. The amateur sees green on the screen and feels the pull. It's breaking out, he thinks. He buys 500 shares at $46.50. He's in. He's committed. He's got conviction. The professional sees the same thing, but they pause. They check something the amateur skipped: confirmation. They ask, has $46.50 actually broken above the previous resistance? Or is this just another fake out, another trap that will snap back to 45.50 cents by Friday? The professional waits. They set an alert. They don't enter yet. Why? Because structure alone isn't enough. Volume, time, and context matter too. By the end of this video, you'll understand why patience at entry isn't boring. It's not what timid traders do. It's what profitable traders do. It's the highest conviction move you can make, the decision to wait. And you'll know the 3 hidden confirmation signals that 99% of amateurs never check. These are the filters that separate the 13% who profit from the 87% who don't. These are the signals that turn entry from a roll of the dice into a mechanical, repeatable process. Let's begin. This opening chapter establishes the foundational stakes of the entire formula. Retail traders bleed capital through emotional, unconfirmed entries, not through bad luck or market conditions. The narrative contrasts 2 identities: the amateur, reactive, FOMO-driven, first to enter, last to understand why, and the professional, thoughtful, confirmation-seeking, willing to miss moves to avoid traps. The chapter plants the anchor belief that entry determines 60% of profitability, a number attributed to Jesse Livermore to build credibility. The amateur's trap is visualized through a specific scenario, bouncing off $45 multiple times, then a gap above $46.50 that looks like a breakout but may be a false move. This sets up the promise of 3 hidden confirmation signals that amateurs never check. The nested loop, why don't professionals share this formula, is seeded for payoff in later chapters. The tone is mentoring but firm, not hype, but a mechanical system that eliminates 70% of bad entries. By the end, the viewer feels the tension. They've been entering like amateurs, and there's a better way. An amateur sees a stock breakout and enters. They see the chart moving, they see green candles stacking up, and they pull the trigger. A professional sees that same stock breakout and asks 3 very specific questions. After all 3 questions are answered with a definitive yes, does the trade happen? The difference between these 2 approaches isn't luck, it's a framework. And that framework is what separates traders who compound wealth from traders who chase their losses into oblivion. Let me show you exactly what those 3 questions are, because understanding them will change the way you read a chart forever. This is where 90% of traders fail, not because they're stupid, but because they don't check the context. They see a stock moving up and assume the move is legitimate. They don't ask the foundational question, is this stock breaking above a level it's tested multiple times? Or is it just making a random wiggle within a range that will reverse by tomorrow? A professional pulls back the tape. They zoom out. They ask a question that amateurs never consider. Has this level rejected price 2 times, 3 times, more? Livermore called these pivotal points, levels where the market revealed its true intention. Every time price bounced off that level, it proved the level mattered. It proved that institutional traders recognized this level as significant. It proved that when price approached it again, something was likely to happen. Think about what that means. A level that's been tested once, that could be coincidence. A level that's been tested twice, that's starting to mean something. A level that's been tested 4 times over 4 weeks, that's not coincidence. That's a battle line. That's where buyers and sellers have clashed repeatedly, and each time, one side won. Now, if price approaches that level again, the professional knows this is a pivotal point. This is where the next move will be determined. Here's the scenario that illustrates this perfectly. You're watching stock XYZ. It's been in a downtrend, but lately it's been bouncing. You notice something, it keeps bouncing off the $45 level. You pull up your chart. You count the bounces. 4 times in the last month, prices hit $45 and reversed. 4 times. That's a pattern. That's structure. Then, one Tuesday morning, you wake up and see XYZ at $46.50. It's up 3% pre-market. Your heart rate picks up. It's breaking out. It's happening. You're about to watch this go to $50, and you need to get in now. An amateur enters here, They buy 500 shares at 46.50, betting it'll go to 50. They have conviction. They have FOMO. They have absolutely no structural confirmation. But the professional? They pause. They ask a question. Has price actually reclaimed $47 and held it? The answer is no. Price bounced to $46.50, but it hasn't actually broken above the previous resistance at $47. It hasn't confirmed that the previous resistance is now support. The professional waits. Not because they're scared, not because they lack conviction, because the structure hasn't confirmed yet. By Friday, XYZ is back at $45. The amateur is down 2% on their position. They're holding, hoping it bounces again. The professional never entered. They saw the fake breakout. They waited. And when price finally does reclaim $47 on a second touch, that's confirmation. That's when the professional enters. Structural confirmation is about testing, about repetition, about a level proving itself so many times that when price approaches it again, you have statistical evidence that something is likely to happen. An amateur trades one test. A professional waits for three. Entry without volume is entry without conviction. This is one of the oldest rules in trading, and amateurs break it every single day. When a professional enters a trade, they don't just see price move, they see money move. Volume is the fingerprint of institutional intent. It's the footprint left behind by smart money, by hedge funds, by the traders with our EL capital on the line. If price breaks a level and volume is 200% above the 20-day average, that's a screaming signal. Institutions are buying. Smart money is rotating in. The move is backed by conviction. But if price breaks that same level on wimpy volume, on volume that's only 50% of average, what does that tell you? It tells you that nobody important cares. It tells you that retail traders are excited, but institutions are sleeping. And when institutions wake up and realize the move has no backing, they'll reverse it. They'll hunt the stops. They'll push price back below the level. Here's the mechanical rule. A breakout on 200% volume is confirmation. A breakout on 80% volume is a trap. The difference is massive, but amateurs see both the same way. They see price above a level and they enter. Volume confirmation answers a critical question. Is this breakout backed by money, or is it backed by hope? Is it backed by institutions rotating capital into this position, or is it backed by retail traders piling in on FOMO? The answer determines whether you enter or wait. Think about the XYZ scenario again. Price bounces off $45, hits $46.50. An amateur sees the move and enters. But what was the volume? If it was 50% of average, that's a red flag. That's amateurs and retail traders excited about a move, not institutions backing it. The professional sees the low volume and doesn't enter. They wait, because they know low volume breakouts reverse. But if that same move to $46.50 happened on 250% volume, the professional enters. Why? Because the volume proves the move is real. The volume proves that money moved. The volume proves that this isn't hype. It's conviction backed by capital. This is where the formula gets lethal, because this is the filter that amateurs never apply. A professional doesn't just ask, is the structure right? They ask a deeper question. Has time confirmed this structure? What does that mean? It means, has this level held for enough bars, enough days, enough weeks to prove it's real? A support level that's been tested and held for 3 weeks is infinitely stronger than a support level that held for 3 minutes. Why? Because time is the ultimate test of legitimacy. A level that holds for 1 bar could be noise. A level that holds for 1 day could be luck. But a level that holds for 3 weeks? That means professionals have tested it. That means algorithms have run. That means institutions have probed the level multiple times and decided it's significant enough to keep defending. Time confirmation also filters out the noise of intraday volatility. A retail trader sees a 5-minute move and thinks it's a trend. A professional sees that same 5-minute move and asks, will this hold for 1 hour, for 1 day, for 1 week? If the answer is no, it's not a real structure. It's noise. The formula becomes clear: structure plus volume plus time equal to entry signal. You need the price to have tested a level multiple times. You need the breakout attempt to come on volume that proves institutional backing. And you need that pattern to have been visible for enough time that it's not just intraday noise. It's a real, repeating, statistically significant event. Until all three align, the professional waits. They don't feel FOMO. They don't feel left out. They don't check their portfolio every 5 minutes wondering if they're missing the move. Because they know something that amateurs don't. The best trades come to you. You don't chase them. The best setups are so clean, so obvious, so mechanically aligned that they practically force you to enter. When all three confirmations line up, when structure is proven by repetition, when volume backs the breakout with institutional capital, and when time has revealed the pattern to be genuine. Entry becomes mechanical. No emotion, no doubt, no second guessing, just execution. This is the difference between trading and gambling. Gambling is entering on one confirmation. Trading is entering when all three confirmations are screaming the same signal. Chapter 2 breaks down the three sequential confirmations that separate professional entry from amateur entry. Structural confirmation asks whether price has tested a level multiple times, making it a pivotal point, Livermore's term, rather than noise. The XYZ scenario illustrates the trap. Price bounces to $46.50, but hasn't reclaimed $47. So the professional waits for a second touch on $47 before entering. Volume confirmation proves that institutional money, not just retail FOMO, is backing the breakout. 200% above average signals conviction, 50% average signals a trap. Time confirmation is the hidden filter. A level tested over weeks is stronger than one tested in minutes. The formula is stated as law: structure plus volume plus time equal to entry signal. The narrative reframes waiting for all three not as hesitation, but as tactical strength. By the end, the reader understands that entering on one or two confirmations is gambling with better odds. Entering on all three is statistical edge building. The cliffhanger, implied but not stated, is, but what happens when you get all three confirmations and the trade still fails? This sets up Chapter 3, position sizing and risk management. You can enter perfectly. You can nail all three confirmations. You can read the tape like Jesse Livermore himself. But if you size wrong, you're finished. Not eventually. Not in a few years. Finished within months. This is the chapter where amateurs stop reading because it's not exciting, and professionals lean in because they know this is where the real money is made or lost. Here's what separates the 13% of traders who profit long-term fro. 87% who don't. And it's not some secret indicator or proprietary algorithm. They understand that position size is risk management. It's not an afterthought. It's not something you decide after you've entered a trade. It's not a detail you'll figure out eventually. It's the foundation. It's the bedrock upon which all profitable trading is built. Everything else, your entries, your exits, your analysis, is built on top of this foundation. If the foundation is weak, the whole structure collapses. Let me show you the difference in how amateurs and professionals think about position sizing, and once you see this, you'll understand why one group compounds wealth and the other group blows up accounts. An amateur trader with a $10,000 account thinks this way: I have $10,000. I'm confident in this trade. I'll risk $1,000 on it. That sounds reasonable, right? It's only 10% of the account. But here's what that amateur doesn't understand. They're not just risking 10% on one trade. They're setting themselves up for catastrophic loss on a streak of losses, which is not a possibility. It's a certainty. Think about what happens next. The trade doesn't work. They're down $1,000. Their account is now $9,000. They take another trade, same sizing. They risk another $1,000. They lose again. Now they're at $8,000. They take a third trade, same sizing, same conviction. They lose again. 3 losses in a row. Now their account is at $7,000. But here's the psychological trap. They're not down 30%. That would be bad, but manageable. They're actually down 30% from $10,000 to $7,000. But that 30% loss means they need a 43% gain just to get back to break even. Most amateurs don't have the discipline to sit through a 43% drawdown without panicking. So what do? They panic. They make emotional decisions. They start revenge trading, taking bigger risks to make back the money faster. And that's when the account truly blows up. The math is merciless. If you risk 10% per trade and lose 3 in a row, you're down 27% and you're panicked. If you lose 4 in a row, you're down 34% and you're desperate. And desperate traders make terrible decisions. A professional trader with the same $10,000 account thinks entirely differently. I have $10,000. This is a good setup based on my 3 confirmations. I'll risk 1% per trade. That's $100. $100. 1% of the account. Now watch what happens. The trade doesn't work. They're down $100. Their account is now $9,900. They take another trade, same sizing. They lose again, down another $100. They're at $9,800. They take a third trade and lose again. 3 losses in a row. They're now at $9,700. They're down 3%, not 27%, 3%. And psychologically, 3% is a non-event. It's noise. The professional doesn't panic. They don't revenge trade. They don't feel the need to make back the money quickly. They're still in the game. They're still in control. And most importantly, they're still thinking clearly. Now imagine the professional takes 10 losses in a row, which they will, because even with perfect entries and perfect confirmations, you cannot win every trade. After 10 consecutive losses at 1% risk each, they're down approximately 10% on their account. They're still in the game. They're still disciplined. They're still thinking clearly. And most importantly, they're positioned to catch the winning trades that are coming. Here's a mathematical truth that most amateurs will never understand. Position size compounds faster than your win rate. Let me state that again. Position size compounds faster than your win rate. A trader who risks 1% per trade and wins 52% of the time will compound their account forever. Their account will grow exponentially, even though they're barely winning. More than they're losing. The compounding effect of 1% risk, applied over hundreds of trades, creates a mathematical curve that shoots upward over time. A trader who risks 10% per trade and wins 60% of the time will eventually lose everything. Even though they're winning more often, the catastrophic losses on their losing trades, combined with the psychological spiral that follows, will eventually force them to blow up their account. The math doesn't work. It can't work. Drawdowns are too large. Panic becomes inevitable. This is why position sizing is not a detail. This is why it's not something to figure out later. This is why professionals obsess over it. Position size is the difference between sustainable, compounding wealth and spectacular, catastrophic loss. I knew 2 traders, both smart guys, both great at reading charts. Both had real capital on the line. Both watched the same markets every day, but they had different approaches to position sizing, and their outcomes couldn't have been more different. Trader 1 was confident. He took a $40,000 account and decided he'd size aggressively. He'd risk 7% per trade. Why? Because he was good. Because his entries were solid. Because he could read the tape better than most people. He made money for 4 months. His account grew to $52,000. He felt vindicated. He felt like he'd cracked the code. Then the market shifted. Interest rates changed. Sentiment shifted. And suddenly his perfectly timed entries started failing. He hit a 4-loss streak. 4 consecutive trades where his structure and volume and time confirmations all aligned, and the market still went against him. It happens. It's part of trading. But here's what happened to his account. $40,000 became $22,000 in 2 weeks. 50% loss. And this is where the psychology kicks in. Trader 1 was panicked. He'd built a narrative that he was good, and now the market was telling him he wasn't. He couldn't accept that. So what did he do? He revenge traded. He took bigger risks. He deviated from his system. He blew the remaining $22,000 down to $8,000. He never came back. Today, he's not trading anymore. Trader 2 worked right next to Trader 1. Same markets, same volatility, same 4-loss streak, same everything. But Trader 2 had a different approach to position sizing. He risked 1.5% per trade. His win rate was actually lower than Trader 1's, maybe 48% compared to Trader 1's 55%. By all rights, he should have been losing money faster. But here's what happened. When the market shifted and he hit that 4-loss streak, his account went from $40,000 to $38,400, down 4%. A non-event psychologically. He didn't panic. He didn't revenge trade. He didn't deviate from his system. He kept trading. He stayed disciplined. 5 years later, with the same $40,000 starting capital, the same market conditions, the same volatility, Trader 2 had $180,000, same market, different sizing, different outcomes. One trader is out of the game. One trader has compounded his account 4.5 times over. The professional uses this rule, and it's not a suggestion. It's not a guideline. It's a 1 to 2%. That's the range. Some professionals go as low as 0.5% if they're being ultra-conservative. Some go as high as 2% if they're more aggressive. But nobody serious goes above 2%. Why? Because above 2%, the math breaks. The drawdowns become psychological events. The losses become triggering. And triggered traders make bad decisions. Once you set position size at 1 to 2 risk, something magical happens. Everything else becomes automatic. Your stop loss becomes the missing variable. Let me show you how this works mechanically. Let's say you're risking $100 per trade on a $10,000 account, 1% risk. You've identified a stock that has structure, volume, and time confirmation. You're ready to enter. But where's your stop? Where's the price that says my thesis is wrong? That's determined by the chart, not by you. You look at the structure, you see that the support level is at $45. If price closes below $45, your thesis is broken. Your stop is at $44.95. Now you do the math, you're risking $100. The stop is 50 cents away, from entry at $45.50 to stop at $44.95. So you buy 200 shares. The math is done. Emotion is removed. You're not deciding how many shares based on feeling. You're deciding based on math. Entry price minus stop price times share quantity equals risk. That's it. That's the formula. Position sizing isn't boring risk management. That's what amateurs think. They think it's a checkbox, something to do after the real trading. Professionals know the truth. Position sizing is the difference between building wealth and chasing pipe dreams. Position sizing is the difference between being in the game in 5 years and being out. When you size correctly, you survive. When you survive, you compound. When you compound over 5 years with consistent entries and consistent sizing, you're wealthy. It's not exciting. It's not dramatic. But it's reliable. And reliability is worth more than excitement. Chapter 3 demolishes the myth that win rate determines profitability. Position size determines survival. The chapter contrasts two specific traders. Trader 1, risking 7% per trade, makes money for 4 months, then hits a 4-loss streak and blows up from $40,000 to $8,000 in emotional revenge trading. Trader 2, risking 1.5% per trade with a lower win rate, experiences the same 4-loss streak, but only drops from $40,000 to $38,400, a non-event psychologically, and continues trading undisturbed. Over 5 years, Trader 1 is out. Trader 2 has $180,000. The professional rule is stated as immutable law. 1 to 2 risk per trade, never more. Position sizing is reframed as the primary determinant of long-term survival, not a detail to figure out later. The mechanical process is revealed. Once you set risk percentage, your stop loss becomes the independent variable, and share quantity is calculated mathematically, removing emotion. The narrative builds to the inversion of conventional wisdom. Position size compounds faster than win rate, making sizing discipline the true edge. By chapter's end, the reader understands that perfect entries mean nothing without proper sizing, and proper sizing makes mediocre entries survivable. This sets up chapter 4, the waiting game and patience as strategy. This is the hardest lesson for amateurs to learn, and it's the one that separates those who eventually profit from those who never do. The best trade is often the one you don't take, not the trade you exit early, not the trade you size wrong, the trade you never enter in the first place. This concept is so counterintuitive, so foreign to the action-oriented mindset of most traders, that when professionals explain it, amateurs hear it as cowardice. They hear it as missing out. What they don't understand is that it's the foundation of sustainable wealth. A professional trader spends approximately 80% of their time waiting, watching, observing, analyzing, not trading. They're in front of the screens, but they're not pulling the trigger. They're watching the tape, but they're not entering positions. Amateurs see this and think one of two things. That's boring. That's lazy. That's money left on the table. or they think the professional is afraid. Wrong on all counts. That waiting, that disciplined, methodical, strategic waiting, is where the money is protected. That waiting is where the edge is preserved. That waiting is the most profitable part of the trading day. Let me prove this to you, Wit. A principle that Livermore lived by and died believing: it is foolish to be right and broke. This is one of the most important sentences ever written about trading. Let it sink in. You can have perfect analysis. You can read the chart perfectly. You can time the entry perfectly. You can understand the macro, the micro, the sentiment, the technicals. You can be absolutely, completely right about where the market is going. But if you trade every setup that comes across your screen, if you enter positions constantly, if you're always in the game, you will be broke. Because you took trades that didn't align with your formula. You entered positions that were 70% confirmation instead of 100% confirmation. You traded your edge away through dilution. Picture this: it's Tuesday morning. The market opens. You pull up your watch list. You see 3 potential setups. All 3 look good. All 3 have structure. All 3 have recent volume. All 3 align with your system, at least partially. Setup 1, a stock that's bounced off support 4 times over 3 weeks. Volume on the recent bounce is 180% of average. Structure is pristine. Confirmation screams. Setup 2, a stock that's bounced off support 3 times over 2 weeks. Volume is 140% of average. Structure is good. Confirmation is present but not screaming. Setup 3, a stock that's bounced off support twice over 1 week. Volume is 120% of average. Structure is there. Confirmation is marginal. An amateur trader sees all 3 and thinks, these all have my confirmations. These all fit my criteria. I should trade all 3. So they do. They enter all 3 positions. They spread their capital. They diversify their risk. They feel like they're being smart, but they're not. They're diluting their edge. The professional trader sees these same 3 setups and does something entirely different. They take set 2, P1. They pass on 2 and 3. Why? Because setup 1 has all 3 confirmations screaming. The structure is tested 4 times. The volume is 180% of average. The time duration is 3 weeks. Everything is aligned. Setup 1 is a 70-30 trade. You versus the market, odds stacked 70% in your favor. Setup 2 and 3 are not bad setups, but they're not perfect setups. Setup 2 is maybe a 65-35 trade. Setup 3 is maybe a 60-40 trade. And here's the key insight that amateurs never grasp. The difference between a 70-30 trade and a 60-40 trade is enormous when you multiply it across 100 trades. Do the math. If you take 170-30 trades with 1% risk per trade, your expected return is significant. You win 70 trades, lose 30 trades. Your net is plus 40 trades. Over 100 trades, that's a 40% return on capital, and that's conservative. But if you take 160-40 trades with 1% risk per trade, you win 60 trades, lose 40 trades. Your net is plus 20 trades. Over 100 trades, that's a 20% return. Half the return, same amount of time, same amount of capital deployed. Now the amateur sees this and thinks, well, I could take both the 70-30 trades and the 60-40 trades. Wouldn't that give me even more returns? No, because now you're trading 150 positions. Your execution suffers, your attention is divided, your discipline erodes, and more importantly, you're adding low-conviction trades to your portfolio, which drags down your overall edge. The professional knows a truth that amateurs take years to learn. It's better to take 1 incredible trade and wait 6 months than to take 10 mediocre trades over 6 months. The incredible trade compounds faster. The mediocre trades dilute the edge. Here's the counterintuitive insight that separates professionals from everyone else. Waiting for the perfect setup is not passive. It's not conservative. It's the most aggressive move you can make. You're being aggressive about your edge. You're being ferocious about your selectivity. When you're waiting for the clearest setup, you're saying something powerful. I will only trade when the odds are stacked 70-30 in my favor, not 55-45. I will only trade when all 3 confirmations are screaming, not when 2 are present. I will only trade when the structure is tested repeatedly, not when it's tested once. I will only trade when time has confirmed the pattern, not when it's an intraday wiggle. That's aggressive. That's not fearful. That's the most confident statement a trader can make. I don't need to trade every setup. I don't need to be in every move. I'm so confident in my system that I can wait for the clearest setups and let the rest pass. The amateur trader trades 55 to 45 setups because they feel the pressure to trade. They feel the need to act. They feel like they need to prove they know something. They need to validate their analysis by entering positions. But that's ego. That's not trading. The professional trader takes 170 to 30% setup and makes more money than the amateur made taking 1055 to 45 setups. That's the reality. One quality trade beats 10 mediocre trades. Quality beats quantity. Always. Here's a distinction that changes everything. Patience isn't patience when you're waiting for something you don't know is coming. That's not patience. That's hope. That's passive sitting. Patience is strategy when you've defined exactly what you're waiting for and you absolutely will not move until you see it. You're not hoping for a setup to appear. You're scanning for a specific setup. You know what you want. You know what the 3 confirmations look like. You know the structure you're looking for. You know the volume you need to see. You know the time duration required. And you're watching for that specific combinatio. And that's active patience. That's strategic waiting. And that's where the money lives. Think about it this way. A hunter doesn't sit in the forest and hope for game to appear. That's not hunting. A real hunter studies the animal. They learn where it drinks. They learn when it moves. They learn what signs to look for. Then they position themselves and they wait. They wait strategically, knowing exactly what they're waiting for and when they'll likely see it. That's what a professional trader does. They're not passively hoping. They're actively scanning. They're watching for their specific setup. And when it appears, when all 3 confirmations align, they don't hesitate. They execute. By the time a professional trader enters a position, the hardest work is already done. They've waited, they've filtered, they've confirmed, they've done the analysis, they've eliminated the noise. Entry is inevitable. It's automatic. It's mechanical. This is why professional traders talk about waiting as a position. Waiting is not the absence of trading. Waiting is the position itself. Your position is to wait. Your position is to watch. Your position is to filter. Your position is to let 90% unpromising setups pass so you can take the one setup that has all the confirmations aligned. And when you understand this, when you internalize this, when you finally accept that your job isn't to trade more, it's to trade better, everything changes. Your win rate doesn't matter anymore. Your frequency doesn't matter anymore. What matters is the quality of the setups you're taking. An amateur trader measures themselves by how many trades they took. I took 5 trades today. I'm active. I'm engaged. A professional measures themselves by how many trades they didn't take. I saw 15 setups today and I took one. I protected my capital on 14 trades. I kept my edge intact. This is the aiding game. This is why doing nothing is sometimes your best trade, because by doing nothing, you're preserving capital. You're preserving discipline. You're preserving edge. And when the clearest setup finally appears, when the structure is perfect, the volume is overwhelming, and the time is right, you'll have the capital, the discipline, and the mental clarity to execute perfectly. Chapter 4 inverts the conventional wisdom that more trading equals more profit. Professionals spend 80% of their time waiting, which amateurs misinterpret as passive or fearful. The chapter establishes Livermore's principle, being right but broke from trading too much. The 3 setup scenario illustrates the difference. An amateur trades all 3 setups, 65 to 35, 60 to 40, 70 to 30, diluting their edge across mediocre positions. The professional takes only the 70 to 30 setup and passes the others. Over 100 trades, this selectivity compounds. 170 to 30 trades yields 40% net gains. 160 to 40 trades yields 20%. The chapter reframes waiting as aggressive selectivity, not passive avoidance. The hunter metaphor positions strategic waiting as active scanning for a specific predefined setup. Waiting as a position is introduced. Your position is to wait and filter. By entry time, the hardest work, analysis, confirmation, filtering, is done. Entry becomes mechanical and inevitable. The professional measures success by how many trades they didn't take, the amateur by how many they did. This chapter bridges chapters 3, sizing, and 5, the complete formula. Proper sizing means nothing without discipline to wait. Waiting means nothing without a complete formula to execute. By chapter's end, the reader understands that patience is tactical, not psychological. Now the pieces fit together, all the individual elements that we've built throughout this video. Structural confirmation, V, volume confirmation, time confirmation, position sizing discipline, the strategic waiting game, they're not separate concepts anymore. They're one integrated system. You have structural confirmation. From chapter 2, you have volume confirmation. You have time confirmation. You're sizing at 1 to 2% risk from chapter 3. You're waiting for the clearest setup from chapter 4. You understand why patience is profitable. You understand why selectivity creates edge. You're ready to enter. But here's where amateurs still fail, even when they understand all the individual pieces. They enter the position and immediately panic. They don't have a process after entry happens. They have a position, but they don't have a plan. They entered because all 3 confirmations were screaming, but the second the market moves against them, the second they're down 1% or 2%, they start doubting. They start questioning their analysis. They start wondering if they made a mistake. And that doubt leads to emotional decisions. That doubt leads to blown accounts. A professional has a protocol, not intuition, not flexibility, a protocol. A series of steps that are followed mechanically, regardless of emotion, regardless of what the market is doing in the short term. This protocol is what separates the 13% who profit from the 87% who don't. Step 1. Enter with all 3 confirmations aligned, non-negotiable. You enter a position only when structure, volume, and time are all confirmed. Not 2 out of 3. All 3. This is non-negotiable. This is the filter that protects your capital before it's even deployed. Structure is confirmed. The level has been tested multiple times. The pivotal point is established. Price is attempting to break through. The volume is confirmed. The breakout attempt is coming on volume that's 200% or more above average. Institutional money is backing this move. It's not retail FOMO. It's conviction. Time is confirmed. The pattern has held for long enough that it's not intraday noise. It's a real, repeated, statistically significant event. Days, weeks, not minutes. When all 3 are screaming, you enter. Your position size is preset. You've already done the math. You know your stop-loss distance. You know your account size. You know your risk percentage. The math is done. The share quantity is calculated. You enter with no emotional guessing about how many shares. It's mechanical. It's mathematical. You click buy. The position is now open. Now comes the second step, which is where most amateurs make their first critical mistake. Step 2. Place your stop-loss immediately. Not later, not eventually, now. This is the moment where discipline is tested. You've just entered. Your position is opening. And your immediate next action, not 5 minutes later, not after you see how it moves, but immediately, is to place your stop-loss order. The stop-loss is not emotional guessing. It's not, I'll take a loss if it drops 5%. It's not arbitrary. It's mathematical. It's the price at which your thesis breaks. Your thesis was, this level is significant. The market is confirming this level through structure, volume, and time. If price breaks back below this level, my thesis is wrong. So your stop-loss is set at the price where the thesis breaks. If the confirmed support level was $45 and you entered at $45.50, your stop is at $44.95. That's not guessing. That's math. That's logic. If price closes below that level, the level wasn't as important as you thought. The institutional buyers you thought were there didn't show up. Your analysis was wrong. You exit. The loss is absorbed. Most amateurs place their stop-loss mentally. I'll exit if it goes against me too much. No. The stop-loss is a hard order. It's sitting in the market. It's placed immediately after entry. Automated. If price touches the stop, you're out. No second guessing. No let me wait and see. Out. This is where discipline becomes physical rather than psychological. The decision has been made before you entered. The stop-loss level was determined by the chart, not by emotion. You're just executing the predetermined decision. Step 3, let it move. Don't add to losers. Don't panic. Don't deviate. Now your position is open. Your stop-loss is placed. And here comes the hardest part for amateurs. letting the trade work or fail based on the original thesis. This is where most amateurs fail catastrophically. The position is open, they're uncomfortable, they're down 2%, and suddenly they start thinking, maybe I should add. Maybe if I buy more shares at this lower price, I'll reduce my average cost. Then when it bounces, I'll make more money. That's called averaging down. That's called revenge trading. That's called emotional deviation from your system. And it's where fortunes are lost. A professional doesn't do this. A professional lets the trade work or fail based on the original thesis. The thesis was that the structure, volume, and time were aligned. You entered. Now the market is testing your thesis. Either the thesis is right and price will move in your direction, or the thesis is wrong and your stop loss will be hit. There's no in between. There's no maybe if I add more. There's no I'm sure it'll bounce. The market has given you a signal. You either wait for a new signal, which would be a break of the stop, triggering an exit, or you wait for the thesis to play out, which would be price moving in your direction. You let it move. You don't watch it every second. You're not staring at the 1-minute chart waiting for validation. You're focused on the original thesis. Will it hold? Will it break? Only after a position is in profit and showing strength do professionals add to their position. This is pyramiding the right way. This is not averaging down into losers. This is adding to what's working. Here's the scenario. You entered at $45.50. Your stop is at $44.95. The thesis is playing out. Price is moving to $46.50, $47. You're now in profit. The position is working. The structure is holding. The buyers are there. The thesis is confirmed not by your analysis, but by the market's action. Now, a professional might add, they might buy more shares at $46.50, increasing their position size in a move that's already working. Why? Because the thesis has been confirmed by price action. The original setup was 70 to 30% in their favor. But now that price is moving, the thesis is 80 to 20 or 90 to 10% in their favor. The risk has decreased. The odds have improved. Adding here is mathematically sound. But notice the timing. They add only after the position is in profit. They add only after the strength is showing. They don't add to weakness. They don't add to uncertainty. They add to what's already working. An amateur does the reverse. They add to losers, averaging down, thinking the price is cheap at lower levels. They cut winners short, taking profit too early, not letting the thesis play out. This is backwards. This is why they lose. Let me state the complete formula clearly, because this is the system that separates professionals from amateurs. Step 1. Wait for all 3 confirmations to align. Structure tested multiple times. Volume 200% or more above average. Time duration proven over days or weeks. Don't enter until all 3 are screaming. Step 2. Size at 1 to 2, risk per trade. Calculate your share quantity based on account size, stop-loss distance, and risk percentage. The math is predetermined. Step 3. Enter mechanically. No emotion, no second guessing. All 3 confirmations are there. You enter. Step 4. Place your stop-loss immediately. Set it at the price where your thesis breaks. Automated, physical, non-negotiable. Step 5. Let the thesis play out. Don't add to losers. Don't panic. Don't deviate. The market will either confirm or deny your thesis. Step 6. Scale into winners only. After the position is in profit and showing strength, add to what's working. Pyramid winners, not losers. Step 7. Protect capital always. Your stops are always in place. Your sizing is always 1 to 2%. Your risk on any single trade is never catastrophic. Capital preservation is the foundation of all compounding. When you follow this 7-step process, you're no longer hoping. You're not emotional. You're not guessing. You're executing a system. And here's the truth that separates professionals from amateurs. Systems, when followed mechanically and consistently, produce compounding returns. Not exciting returns, not quick returns, but reliable, repeatable, compounding returns over years and decades. The amateur trader wants to know the secret to finding winners. They want the magic indicator. They want the perfect entry signal. They want the secret that makes them always right. The professional knows a different secret. The professional knows that the secret isn't finding winners. The secret is never losing catastrophically on losers. That's the entire edge. That's the complete difference. When you size at 1 to 2 risk and you follow your stops, no single trade can hurt you. When you scale only into winners, you're compounding gains while minimizing losses. When you wait for all 3 confirmations, your win rate is already above 50%. When you have a win rate above 50%, 1 to 2 sizing, and you scale into winners while protecting on losers, the math compounds. It's not about being right every time. It's about being right enough, often enough, while never losing catastrophically. That's the entire formula. In Chapter 1, we talked about how amateurs enter emotionally unconfirmed. They see a stock moving and they buy it. They have no filter. They have no process. They're reactive, not strategic. By Chapter 5, you've moved from amateur identity to professional identity. You have a filter, the 3 confirmations. You have a process, the 7 steps. You have discipline, 1 to 2 sizing, immediate stops, scaling only into winners. You have a system, and that system, followed religiously, over hundreds of trades, across years and decades, creates compounding wealth, not quickly, not dramatically, but reliably. This is the entry formula complete. This is how professionals think. This is how professionals trade. This is how the 13% who profit long-term actually operate, day after day, trade after trade, year after year. Chapter 5 synthesizes all previous chapters into a unified, mechanical protocol, the 7-step entry formula. The chapter walks through each step seek. Essentially, confirmation, structure plus volume plus time, sizing 1 to 2% risk, mechanical entry, immediate stop placement, thesis execution without deviation, pyramiding only into winners, and capital protection. The narrative emphasizes that after entry, the hardest work is done, execution is mechanical. The chapter addresses the most common amateur failure, adding to losers, averaging down, and cutting winners short. The professional does the opposite, scales winners only, protecting losers with stops. The final maxim, the secret is never losing catastrophically on losers, inverts the amateur's focus from win finding to loss management. This reframing is critical. Amateurs obsess over finding perfect trades. Professionals obsess over never losing more than 1 to 2% on any single trade. The narrative closes the opening loop from Chapter 1. Amateur entry is emotional and unconfirmed. Reactive, FOMO-driven, no filter. Professional entry is mechanical and protected, strategic, confirmation-driven, systematic. By following the 7-step formula, the reader is moved from amateur psychology to professional psychology. The formula is presented not as theory, but as law, steps that produce compounding returns when followed consistently over time.